all federal employees dream about having a massive TSP account. And overall, having a large TSP account is wonderful. It's really, really nice to have, knowing you've got lots of money to get you through the ups and downs of retirement. However, what about the dark side? What about the unintended consequences of a large TSP account? Now, I'm not alluding to the fact that it'd be better not to have a large TSP. No, I'm not saying that. It is almost always better to have more money in retirement, just for the what ifs. However, there are some things that you need to make sure you keep in mind if you do have a large TSP. Number one is RMDs. It stands for Required Minimum Distributions, which, let me give you the short version on this. Basically, in your 70s, between age 73 and age 75, depending on when you were born, that's when RMDs start. And this is what RMDs are. The government comes knocking on your door and they say, hey, look, you know all that money you've got sitting in your TSP right now? You know all that? You know all of it that's sitting in your traditional TSP? Yeah, we've never received taxes on that money. We want to start today. And they will require money to start coming out every single year, starting again in age 73, 75, and you have to pay taxes on that money. And a side effect of having a really large TSP is RMDs are really large, because RMDs basically will give you a percentage of your account that has to come out. So if you only have, let's say, 100 grand in TSP, then you may have to only pull out a small amount. If you've got 3 million in TSP, it's going to be a much, much larger amount, which means all that income gets added into your taxable income. Okay. Now, again, this is not a terrible problem to have, because more money is great, more income is great, but you have to, again, look at the unintended side effects. What tax bracket will that put you in? For example, that's my next point. What about taxes? Things get messy as your income goes up. We all know that most low earners don't even hire a, let's say, accountant or CPA to file their taxes, because it's pretty simple on the low end. But the moment your income starts going over a certain threshold, things get complicated. And one of those examples is IRMAA. Now, if you're not familiar with IRMAA is the fancy way of saying Medicare Part B premiums. Okay, and Medicare is, again, the health insurance that most federal employees get on at 65. Basically, how much Medicare Part B costs for you goes up based on your income. If you didn't know that, Medicare, the cost of it changes with your income. Once you go over a certain threshold, it costs you more. If you're a low earner, you'll pay the base rate. If you're a high earner, you will pay more. And at least in 2025, for a married couple, the limit is about 200,000 or so, where basically if you make under 200,000 gross with everything included, right? It's actually modified adjusted gross income for those people that love the technical. If your modified adjusted gross income is under 200,000-ish, then you'll pay the base premiums for Medicare, which is great. You pay the lowest amount. However, the moment it goes over this, then you start paying more. And if you're single, the limit is a lot lower than 200,000. It's much, much less. You can look up Medicare Part B premium chart online to find, for whatever year you're watching this, to find the premiums for this year. But the premiums right now are about $185 per month per person. Again, that only goes up as your income goes up. So all of these things kind of stack on top of each other. Is you have a large TSP, so therefore you have large RMDs, right? And therefore you got to pay large taxes, and your tax bracket may go up because of that. And that those RMDs might also increase what you pay in Medicare. So basically, the more you have in TSP, the more things there are to be looking at to try to pay as little in taxes as possible, and in IRMAA as possible. And because at the end of the day, if you don't really care how much you pay in taxes or Medicare premiums, then you can do whatever you want. It doesn't matter. But if you care how much that money you're actually able to enjoy or actually able to pass on to your kids or to charity, and how much you send to the IRS, if you care about that stuff, then how you handle it can make a really, really big difference. For example, a couple things to keep in mind is there's a couple things you can actually do to reduce RMDs, or the tax impact of RMDs. There's something called, if you like to give to charity, there's something called QCDs, all right? A QCD is basically taking a piece of your RMD, and all these acronyms, right? And you send it to charity, and that money disappears. It doesn't impact your IRMAA or taxes or anything. That's a great strategy for people that give to charity anyway. So look up QCD if that is relevant to you. Also, you can try to get money out of the traditional TSP before RMDs start, because RMDs only impact the traditional side. They don't impact Roth. They don't impact Roth IRAs. It's just traditional pre-tax accounts like traditional IRA, traditional TSP, etc. Those are some of the things you can do. And again, I'm not saying that having a lot of money in the TSP is a bad thing. It is a great thing. It's so nice to be comfortable, to have plenty of money in retirement. But just keep in mind, whenever you have a lot of money in there, there's a lot more things that start stacking up that if you're not aware and planning for it, it can be really put you in a tough spot later in your retirement. So I hope that's helpful. I'll see you guys in the next video.